the exact date of next stock market crash 2026. The Federal Reserve just announced they're printing money again, not sometime in the future. Not next quarter. They've already started. $40 billion every single month. And at the exact same time, the biggest private companies on Earth are rushing to dump shares onto the public. SpaceX, OpenAI, all preparing trillion-dollar IPOs. This exact pattern has happened twice before. In 2000, the Nasdaq crashed 78%. In 2021, 95% of IPO investors lost money. Stay until the end to see the timeline and what smart investors are doing right now. Part 1. The numbers don't lie. Let's start with something very simple. Numbers don't lie. Warren Buffett's favorite measure for valuing the market is the total value of all companies compared to the size of the economy. The total market cap is around $66 trillion. The GDP of the United States is around $30 trillion. Divide 66 by 30 and you get over 220%. Anything above 100% means the market is overvalued. Back in 1999, before the dot-com bubble burst, the number was 115%. The market then collapsed by more than 60%. But today, it isn't 115%. It isn't 150%. It's over 220%. If you only looked at that, you would think the market should already be in ruins. And yet, here we are. Look at the companies driving the S&P 500. Nvidia's PE ratio is 53 to 55. Amazon's is 35 to 37. Microsoft's is 35 to 40. Tesla? Over 280. Investors are paying $30, $40, or even $280 for every dollar of earnings. Would you pay $50 for a candy bar that costs $1? Yet that's exactly what's happening. Before the dot-com crash, S&P 500 PE ratios were running 29 to 32, roughly the same as today. So if valuations are off the charts, if even Warren Buffett is sitting on cash instead of buying stocks, why hasn't the crash arrived? The answer is not simple, but once you understand it, everything falls into place. Part 2. Why the Fed is printing again. While everyone's been obsessing over interest rates and inflation, the Federal Reserve made a much bigger move that almost nobody noticed. They started something called reserve management purchases. That's just a polite way of saying we're printing money again. $40 billion a month. That's $480 billion a year. Jerome Powell will tell you this is not quantitative easing. He'll say it's just a technical operation. And technically he's not lying. They're buying short-term bills instead of long-term bonds. But here's what actually matters. The Fed's balance sheet is expanding again after shrinking for 2 years. Bank reserves hit a 4-year low. The Fed's emergency lending window spiked to record usage at the end of the year. Translation. Banks were so short on cash they had to tap emergency funding. That is a stress signal. Let me explain how this works. When you deposit $100 into your bank account, where does that money go? It doesn't sit in a vault. That money is immediately lent out to someone else. You give your friend Sarah $100 to hold. She writes you a receipt. Then she gives $90 to your neighbor Tom. You still see $100 on your receipt. Tom has $90 he can spend. The total money just went from $100 to $190. That's fractional reserve banking. And here's the wild part. Since March 2020, U.S. banks have been required to hold 0% in reserves. 0. They can legally lend out every single dollar you deposit. So what happens if everyone wants their money at the same time? That's called a bank run. And the system collapses. Silicon Valley Bank in 2023. Tech companies got nervous. Withdrawals accelerated. The bank didn't have cash. They sold bonds at a loss. Word spread. The bank collapsed in 48 hours. That was the 16th largest bank in America. When the Fed prints $40 billion a month, it's not about stimulating growth. It's about preventing systemic failure. It's about keeping enough liquidity so banks can meet withdrawals. And when that money enters the system, it doesn't sit still. It pushes asset prices higher. And when markets are inflated, founders and insiders rush to cash out. That's why trillion-dollar IPOs are showing up right now. Part 3. The hidden forces holding the market up. There are 2 major forces propping up this market. Force number 1, government spending. The U.S. government collects around $5 trillion in taxes and spends about $7 trillion. That's a $2 trillion annual deficit. That borrowed money flows into people's hands, into corporations' earnings, and back into the market. Much of that $7 trillion finds its way to companies, then to employees who spend it, elevating corporate profits. With $38 trillion in debt and annual interest costs over $1 trillion, how long can this continue? Likely not much longer. Force number 2, dollar devaluation. When the government floods the system with borrowed money, it creates devaluation. If there were only $10 in an economy, those dollars would be valuable. If suddenly there are $20, each one is worth less. That's inflation. The current administration wants a weaker dollar for cheaper exports. Countries like China want transactions settled in other currencies. U.S. treasuries aren't the risk-free assets they once were. When demand for the dollar decreases, its value decreases. And when the government floods the system with dollars, inflation accelerates. But here's how this props up stocks. Investors are betting on the dollar losing value. As it weakens, companies raise prices. Earnings rise not because they're producing more, but because prices are higher. If a company sells a product for $100 and earns $10, but inflation pushes that price to $200, earnings double to $20, even if nothing else changed. That's the hidden engine. It's not growth. It's inflation disguised as growth. And inflation works in favor of people who buy assets with debt. Big investors borrow large sums to buy stocks. If inflation stays high, they win big. But here's the problem. The top 10% own almost 90% of all stocks. As the dollar loses value, the rich get richer. The bottom 90% see costs rise while their dollars don't stretch as far. These forces won't last forever. They delay the crash, not prevent it. Part 4. The IPO warning sign. The biggest private companies are all preparing to sell at the exact same time. SpaceX, trillion-dollar valuation, roughly 60 times estimated revenue. It would be the largest IPO in history. OpenAI, also targeting a trillion-dollar valuation, possibly in 2026. If it's such an incredible long-term investment, why are early investors so eager to sell it to you? Databricks, $134 billion. Anthropic, $350 billion. Anduril, $30 billion. Notice the pattern? Almost all AI or tech, sky-high valuations, all planning to sell in 2026, all rushing to the exit at the same time. Why would the smartest founders and investors want to sell right now? Because they're reading the same signals. Think of it like a lemonade stand. When's the best time to sell? Summer. Everyone's thirsty. People have money. Nobody's worried about winter. When's the worst? January. It's cold. Nobody wants lemonade. Everyone's broke. Founders wait for the perfect window. Stock prices are high. Investors are optimistic. Liquidity is flowing. The Fed is printing. Valuations don't matter because this time is different. The problem? That perfect window often happens right before the peak. We've seen this twice before. In 1999, there were 457 IPOs. Stocks doubled daily. Companies with zero revenue were worth billions. 86% were losing money. Nobody cared. It was the new economy. Then the NASDAQ dropped 78%. $5 trillion evaporated. Link, Webvan, gone. In 2021, the Fed printed $4 trillion. IPOs exploded. Rivian raised $12 billion with basically no revenue, worth more than Ford and GM combined. By 2023, only 5% of 2020-2021 IPOs were trading above their offering price. 95% of investors lost money. The IPO frenzy wasn't near the market top. It was the top, and now we're staring at the biggest IPO wave in history. Part 5. The 3-stage timeline. Let me connect all the pieces. There are 3 stages. Stage 1, economic weakness. Growth slows. Banks need reserves. Already happened. The Fed cuts rates. Already happening. The Fed starts printing. That's exactly where we are right now. Stage 2, the liquidity party. New money floods in. Stock prices rally hard. Valuations stretch. Everyone feels like a genius. Risk assets go vertical. That's where we're heading. And we could go much higher. I'm almost fully invested. Midterms coming. Money printing back. Interest rates coming down. Smart money already sees the peak forming. Private companies rush IPOs at insane valuations. Retail investors buy everything because they want to be early. Stage 3, the music stops. Here's what most people don't understand. After an IPO, there's a lockup period, typically 6 months. Early investors and founders can't sell. Then 6 months later, everyone who couldn't sell suddenly can. Massive wave of insider selling. Layer that on top of midterms, which can create volatility. That's why I'm watching late 2026. We're in year 2 of the presidential cycle, historically not great for markets. Year 3 is typically much better. That pattern's been about 90% accurate since 1933. Part 6. What smart investors do now. So what's the playbook? I stay automated. I use stops on every position. I keep position sizes reasonable. I start looking at high-quality companies when they become cheaper. ARK ETFs are my canary in the coal mine. When they're ripping, I get cautious. When they fall while the S&P holds, money's rotating from risk to reliability. That's an early signal. What I actually do, I don't buy IPOs. Ever. There are 5,000 publicly traded companies in the US with years of audited financials. When one new stock shows up and people say it deserves my attention more than the other 5,000, the math doesn't work. I always ask, why are insiders selling? Why am I being their exit liquidity? Valuations matter. 60 times revenue isn't investing. It's speculation. I like SpaceX as a business more than most AI companies. AI is brutally competitive. SpaceX has thousands of satellites in orbit. That's a real moat. The US military relies on Starlink. They could become a global provider without building a single tower. But not at $1 trillion during peak euphoria. This time is never different. Don't panic at bottoms. Markets crashing isn't a bug. It's a feature. Right now, Fed printing supports markets. Trillion-dollar IPOs will excite everyone. We may see higher highs this year, but those IPOs are warning signs. My base case is a correction toward late 2026. If political gridlock increases, markets may react negatively. The market hasn't crashed because temporary forces are propping it up. When those forces weaken, the market won't gradually decline. It will snap back. The crash isn't canceled. It's delayed, and the longer it's delayed, the bigger it becomes. This isn't about predicting doom. It's about understanding the cycle so you can protect yourself and make smarter decisions when others panic. Let me know your thoughts in the comments. Subscribe to stay updated, and I'll see you in the next one. Just a reminder, I'm not a financial advisor. This video is for educational purposes only.